Oh, great. Good morning, ladies and gentlemen. As directed by Manitoba Health, we're requesting people avoid close contact within 2 meters with anybody showing symptoms of the respiratory illnesses such as coughing or sneezing. If you are experiencing flu-like symptoms, we request that you excuse yourself from the room. I'd like to call the meeting to order. I would like to begin by acknowledging that we're in Treaty 1 territory and the traditional homeland of the Métis Nation. My name is Ron Merritt. I'll be your chairperson this morning. And introducing the panel members, Mr. Brent McIntyre to my left, and to his left is Lynn Nesbitt. Our recording secretary is Belen Rojo, and representing the city of Winnipeg from the assessment department is Matthew Baracus. This morning we'll be hearing an application for revision of the assessment roll according to the Municipal Assessment Act. The matters for which revision is requested has been described in each application and will limit discussions to those matters. The statements that the applicant or the assessor make at the hearing are sworn testimony, and anybody speaking in these matters must be sworn in. Please be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by City Council and is independent of it, along with the City Administration. We make our decisions based on the evidence provided at the hearing and issue a written order that will be mailed to all parties as soon as possible. Please note that the board's decision in respect to application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to Court of Queen's Bench if the matter pertains to application for exemptions from taxation. Should you wish to appeal, information on how to do so will be included in the board's order. In respect to the hearing this morning, I will confirm the matters to be addressed with each applicant following the swearing in. We'll then have the assessor's testimony, followed by questions and the other applicant may have, and then it'll be the applicant's testimony followed by questions. Each party will have the opportunity to summarize if they wish. Once all evidence about the application has been brought forward, the applicant may leave. The process will repeat for each of the items on our docket this morning. The session will close after all applications have been heard, and the board will deliberate in private and make its decisions. You will receive your order by registered mail as soon as possible. As information, all public hearings are live stream recorded and will be part of the public record. We'll ask our secretary to swear in the assessor.
Please state your full name. You affirm the evidence to represent the truth, the whole truth, and nothing but the truth.
We'll get Mr. Newman sworn in.
Mark Newman.
You affirm the evidence to represent the truth, the whole truth, and nothing but the truth.
I do.
Thank you.
The first time on the docket that we're going to deal with is 311 Alexander Avenue. Belen, I just need a little hand here. Okay. All right. So we'll proceed with Alexander. So, Mr. Barocas, you can take us through the subject property.
All right.
Unless, Mr. Newman, you wanted to talk about what is going to proceed?
So there's a recommendation in terms of value, which I'm
Okay.
prepared to accept.
Okay,
There's also a penalty issue, which I'm going to address.
okay. So maybe what we'll do is we'll go through the subject property, and is there a recommendation from the city or in your brief?
It's from, well, it's actually, it's detailed in my brief, but I understand that the assessor may be handing something out, or I'm not sure.
Okay, so you may proceed.
Yeah, so there is a recommendation. We had talked, and what had happened was I went on holidays in between the time him getting back to me saying the recommendation was fine. So I'll read in the file and then we can get started. Okay. File number 20-199, 311 Alexander Avenue, roll number 13099069070. Assessed value for 2021, April 1st, 18 reference date, 12,899,000. Going to be reducing the property to $10,364,000 rounded. And I believe that's accepted by the.
And Ms. Barocas, can you just tell us why the recommendation? How did you conclude the value to the decreased amount?
Yeah, no problem. So there was there's non-cooperation on the property. However, I did look at the 2016 numbers, which I guess I didn't include in my brief, but they are based on the 2016 numbers. They will, pretty sure just as I glanced, would be in Mr. Newman's brief. So what I did is I saw that we have overstated the income on the property, and I did calculations based on the 2016 mailer and an analysis, and saw that we were about $2.5 million too high, so it warranted an adjustment.
And Ms. Barocas, is the city still seeking the non-compliance?
Yes. So I'll talk about that. Basically what happened was, we'll skip over the valuation part of my brief. And then you go to page 18, you'll see the registered envelope sent to who was the property manager at the time the mailer was requested, 202 83 Sherbrooke Street, which is Imperial Properties. Go to page 19, show that it was delivered. It was signed for as received. We didn't get it back, so I'm seeking
The non-compliance issue, just offhand, was it ever sought after before?
on this property. No, there was a replat on the property. They were fine handing in their 2016 mailer. You'll see on page 2. They didn't hand in their 2017 mailer. So, as such, penalty is being asked for.
So, just to conclude, Mr. Newman, you're in agreement in regards to the rec?
Yes.
Okay. So we want to talk about the non-compliance issue then?
Yes.
All right. I think the floor is yours then.
Thank you. Just a couple of questions of the assessor. You've provided at page 18 the envelope. I gather you did not personally prepare this envelope or send out whatever was sent with it?
That is correct.
And I noticed there's nothing attached in terms of what was sent out. So we don't know what was actually sent out in this envelope, do we?
It's not attached to it. these envelopes and tracking gets scanned into our system. It's a result of the income and expense tailer being mailed to them.
I understand, but before the board this morning, there's no indication of what was actually in the envelope, correct?
That would be correct, yes.
And additionally, have you done a title search on this property?
I have not done a title search on this property.
Okay. And are you aware that title searches typically show an address for service in relation to the property?
And in terms of, yeah, there's an address, yeah. Actually.
All right, those are my questions. Thank you.
Thank you. Mr. McIntyre, questions of the assessor?
I have no questions.
Ms. Nesbitt?
I have a rebuttal brief.
Okay. What's that? I can't hear you well.
Yeah, it is.
Okay.
There is a page and a half of text, page and a bit of text. There are 22 pages of attachments. The first 11 of them are the three titles, and the pages are numbered in the lower right-hand corner, are the three titles that make up this property. And you can see that the registered owner on page number 1 of the attachments is 311 Alexander Avenue, Inc. If you go to page 3, you will see circled with an arrow address for service, care of 235, 530 Kenniston Boulevard. If you keep turning the pages, page 5 is another title. Page 7 is again the same address, 530 Kenniston Boulevard. Page 9 is the third title. Page 10 is the additional address, same address for service at 530 Kenniston Boulevard. It's also interesting, page 12, the history on this property is that it was an old warehouse, stated to be the first concrete reinforced building in Winnipeg, built in 1906. But as a consequence of that, the developer was able to obtain a grant, and page 12 is a letter from the city relating to that grant, directed to the company at 76 Deer Ledge Place, and 76 Deer Ledge Place is the home of Sean Barnes, who's the principal of the owner of the property. And then if you go to page 13 and through to the end, you've got the decision of the municipal board in a case called Mo Investments that was heard in July of 2018. Howard McCubbin was the assessor. I was counsel in the matter. And what this case related to was the value of the property at 946 Corden, but more importantly, it related to the issue of the penalty. And in this case, the assessor had actually sent a second request by registered mail to the address for service shown on the title. And if you go to the page that is numbered 16 in the lower right-hand corner, page 4 of the actual decision, Mr. McCubbin talks about the assessor mails correspondence such as assessment notices and requests for information using addresses for service found in land title searches of certificates of title. The property's title shows the address for service as being Mo Investments, 946 Corden. So in this case, what happened was the assessor sent a second request to 946 Corden. There were 2 years. It was a tenanted property. This was the old Chicken Delight property on the corner of Corden in Stafford. So there was a tenant in there. The tenant signed for the request in 2011. In 2012, the request was returned unsigned, and the assessor sought to seek the penalty, and the board declined to impose the penalty for both years in respect of 2011, indicating that the assessor must prove that the tenant was authorized to receive the request for information, failing which that was not a valid service. And in the second year, indicating that because it was returned, that was not a valid service either. Importantly, in that regard, if we go to page 20 of the decision, you get the analysis and conclusions of the board, page 20 in the lower right-hand corner, page 8 at the top. And the board then summarizes in a series of bullets. Third bullet down, the onus is on the assessor to establish the request for information was made and found its way to the property owner. Down at the bottom, prior to ordering a deferral penalty under section 62.2 of the Act, and that's the equivalent section for municipal board hearings, the board must be satisfied a request for information was made and it's found its way to the owner. The assessor has the onus to establish these facts. Down at the next page, page 9 of the decision, 21 in the lower right-hand corner, at the bottom, because the assessor has not satisfied the onus of proving the request for information was received, the board is unable to impose the deferral penalty. And then finally, at the top of page 10, the board made what could be described, the last page, as an editorial comment, essentially saying to the assessor, exercise more discretion in which cases you decide to seek the penalty. And if it's uncertain, maybe you don't want to be raising the failure to comply. So the reason I draw this to your attention is ultimately, and the reason I've given you the titles to the property is to establish that the address for service on the title, which Mr. McCubbin indicated in that case is something that is relied upon, was 235-530 Kenniston Boulevard. The fact that it was sent to a different address doesn't establish proper service. And additionally, as the assessor has acknowledged, we don't actually know what went in the envelope. We can speculate, of course, but we don't actually know what was sent out. And so my submission to you ultimately is that the assessor has not met the onus and the penalty should be denied. Thank you.
Marcus, questions?
Yeah. So are you aware that at the time of the mailing of the incoming expense mailer, to Unit 202-83 Sherbrooke was the mailing address we had as provided by the property owner in our system?
I wasn't aware, but I'm not surprised to hear that.
And are you aware that it wasn't until May of 2020 that the property owner indicated us in a changes to tax installment payment plan that they were switching their mailing address to 76 Deerledge Place?
I wasn't aware of that either.
So, and the property owner was compliant in regards to handing in the 2016 mailer. That would have been sent to 83 Sherbrooke as well, correct?
I don't know where it was sent.
Those are my questions. Thanks.
Thank you. Mr. McIntyre, any questions, either party?
Just one question, either party. Who signed the card?
I don't know that either.
That would be delivered. doesn't say signatory name on page 19, but there is a signature that it was received.
Okay, thank you.
Ms. Nesbitt?
Mr. Lucas, can you take me through some of those dates?
Okay.
So at the time of mailing,
At the time of the mailing, the registered mailing, which would have been the second mailing, but
yes, so that's June.
June 8th, 2018, on page 18,
Mhm.
we send a registered mailing out. That's the second mailing of the mailer. No, I did not include the pages of the blank mailing. That was 2018. They switched it. I got this yesterday.
So on June 20,
Mhm.
the address in this was consistent with that on.
Yes, yes.
Okay, so in land titles, it was also.
I don't know what it was in land titles. We just have the mailing address that we've been sending their documents.
Okay, and then.
In May of this year, it was switched to 76 Deer Ledge, which on the application, if you look at the application, he has Alexander crossed out and he has the current mailing address in place.
The current address
Yeah.
being.
The current address is 76 Deer Ledge. That's the current. But at the time of the mailing, the address on Sherbrooke was where we were sending information.
I just have one redirect. On the permit that's included in part of your brief map, it's showing, and this is dated 2014, the applicant, 530 Keniston, the owner of 311 Alexander, 530 Keniston as well.
Sorry, can you say that last part again, please?
On the permit, the owner is shown at 311 Alexander's Avenue Inc. is the owner, and the address is shown as 530 Keniston Boulevard.
Yep. So, at that time, I'm not sure where that address came from. Maybe that's the address they applied for the permit under, for where we've been sending their documents and their mailing address. At the time, it's 83 Sherbrooke, so I don't have any explanation as to why that 2014 permit has 530.
Because that's consistent with the titles, correct?
As per the rebuttal.
Yeah.
Yes.
Okay, thank you, that's all my questions.
I guess the panel is going to have to make a ruling in regards to the non-co-op issue. Quantum is okay. So maybe what we'll do is we'll shut down the cameras and Mr. Newman, Ms. Brokus, Mr. Story, you can have a little recess.
And just before I go,
Okay.
just so we're clear on one thing, I think the assessor has confirmed that until May of 2020, in their records, the address was 530 Keniston as it is in the title. So, all right, I'll leave you.
Thank you. All right, we'll call the meeting back to order. And the request for the non-co-op from the city will be denied.
Thank you. Good morning to all. Thank you all. Thank you. Nice seeing you all and swapping fish tails.
Thank you.
Okay, Mr. Story, you may come forward and bring your material. We'll have you sworn in.
Sanitize the chair.
Okay.
Sorry.
Okay.
U.S. Government to represent District Coach. Okay, copies of your stuff at the end.
Okay, go on. Now we're going. I'm gonna go to Maryland.
Yeah.
Okay.
These ones,
Okay.
and then go back to this folder down at the bottom,
Okay. Folder. Yep. Okay.
and then you'll open the ones that you want.
Maryland. Okay. Good.
All of
Brief.
these ones.
Okay. Just run in.
Yes, I did, sir.
Thank you. Morning, Mr. Story.
Good morning.
Okay, we're gonna go to 183 Maryland Street. So, Mr. Baracus, whenever you're ready, you can take us through the subject property.
All right. File number 20-542, 183 Maryland Street, roll number 12090402000, roll year 2021, reference date April 1st, 2018, assessed value 761,000, 2019 value is 74,000. It's an apartment on Maryland, just south of Broadway in the Wolseley area. Res app, one building, 2 stories, 1969, don't have an effective date on the property. 11 suites, 8 outdoor parking spots. So construction class C, masonry bearing walls. Gross floor area 6,357. Turn to page 2. See that they haven't been historically compliant. The old owner, that is. The property was purchased in February of 2020. So it's inappropriate to punish the new owner because the old owner didn't. So I don't think that's fair, and so I'm not seeking the penalty on this one. Unfortunately, as such, we don't have income and expense information prior to the reference date. So just skipping ahead, I see that Mr. Story and I, he's in the same predicament as I am in terms of expense information. So it looks like our model NOI is something that we agree upon, which is found on page 3 of my brief, which is 36,532. We've got the 4.8 cap rate as per age, area, and size modeled for that area. Our capitalization rate evidence, sample sales. I know from the familiar faces around the table, we've gone over this a few times. So the second from the bottom table shows our sales of properties in the area, not in the area, in the city in general, ranging from just over 4% to 5%. In terms of cap rate, there's more sales that are higher. There's also more sales that are in this lower cap rate bracket, but it's just to substantiate the fact that our model draft cap rate is in line with some of the properties that actually transact in the open market. Page 5 is our capitalization rate table. As per usual, you've seen it before, so I'm not going to dive into it. So it seems like it's a cap rate issue on this property. It gets 4.8 modeled. That's my evidence. Thanks.
Thank you. Mr. Story, questions of the assessor?
Yes, thank you. Okay, so on the first page, we see that this property is built, excuse me, in 1969, is that correct?
Yes.
And there's no variant applied by the city, so we can assume that it's true to its vintage. There's no permitted work. There's been no reason to assume that the effective age should be altered from the original.
Well, we don't have any history of mailers, so we don't really know what's going on financially there, and I couldn't find any pictures online. So there's really no evidence either way, so we don't have anything.
Have you visited the property?
I don't know why.
You looked at a photo of the property?
Probably.
Okay. Now, I noticed that you include a post-reference sale here.
Oh, and that, yeah, I didn't cross that out.
So that shouldn't be included.
Mhm.
All right, it's fine. Now, I guess it is a new owner, so we've deferred to your NOI, which is fine. It seems reasonable. Now, the only issue that we have here is a 4.8 cap rate. Does that not seem aggressively low for a property of this? Well, I suppose you don't know about the condition. I'll speak to that in my presentation. But we have a number of one-bedroom suites. Traditionally, these are the hardest types of suites to rent in this area, generally low income. An older building, not in good condition. 4.8%. When I look at your cap evidence, that puts it, that puts it lower than something like Ward, which is a far superior property. So I'm just wondering how the model generates a 4.8 cap on an older, under-improved property when we see the information that we have here based on your other cap rates.
So, the area that property's in, Wolseley, I'm sure you're all familiar with that area. It's a lot of young people, kind of hip, urban area, lots of little restaurants. As I was going through my 20s, I know a bunch of people lived in that area, lived in one-bedroom area. Units, it seems that I would say actually the opposite, that this 11 one-bedroom property, if it is not improved, is actually a really great investment opportunity to get in there, buy and perhaps do some renovation, make some gains.
So your cap rate is based on the potential to renovate. Is that what you're saying?
No.
Okay. All right. I do have a cap rate rebuttal that I provided to you. A rebuttal document for the assessor's cap rates.
All right.
Okay. So basically, I'll just speak to that very quickly. Of the 4 cap rate comparables that are included here in the assessor's evidence, 3 of them were purchased with the intention to renovate. We've also included the Manitoba Municipal Board Order A18431, which states that effectively that it's not appropriate to use properties purchased with the intention to renovate because they show an intention that's difficult from the typical motivation, and they don't tend to take into account the post-renovation income stream. So it should not be included. And then further to that, the assessor has the burden of proof, but we don't see any workup or supporting documents. So it's our position that these cap rates should not be considered. And I guess just as a final question here, you're aware that there's a property that's sold on Balmoral. You mentioned Wolseley. This is actually West Broadway, though, right?
I was driving around this area last night, actually. It's more like Wolseley.
But by the city's own mapping, it's classified as West Broadway.
I don't have a map in front of me.
All right. Well, we have a sale at Balmoral, very similar, built in 1972, and that transacts with a 6.75 cap. I'm just very surprised at this 4.8. But okay, so can you tell me then if we don't have any cap rate comparables here, can you tell me that were there any properties in this area that were included in the original cap rate study to derive these rates?
Cap rates are modeled based on expense.
Okay. All right, and then just very quickly on the broker's cap rates, table. You mentioned here it's the variables are size, age, and location. Does condition come into play at all?
Size, age, location.
Fourth paragraph, Joe.
Okay. Yeah, well, I mean, their ability to generate income is what's calculated through draft modeled. Cap rates are determined, and then we split them up into size, area, and location to identify which sort of cap rate should be applied to respective properties, various variables.
Okay, so when I look at your multifamily section here for the brokers, the only ones who look at low-rise A or B, CBRE. Now, these studies typically only include investment-grade properties. Can we agree that this is not an investment-grade property?
Do they only include investment grade?
Yes. Brokers' reports only include investment-grade properties.
Sure, what was the question again?
My question is, you include the brokers' reports. Can we agree that this is a low-rise building?
Yes.
Okay. And can we agree that it's not an investment-grade building?
No.
Okay. Well, even if you don't agree that it's not an investment-grade property, you can see that the brokers would apply this no less than 5.75 in my mind and 6%. But that's even, it has to be higher than that because it isn't a non-investment-grade property. But I suppose we can agree to disagree on that. Those are my questions. Thanks.
Thank you. I gotta talk about his rebuttal. Okay. So, go to his rebuttal. So on page, starting on page 11. It's 191 Roach, contending that the sale is no good because they indicated $100,000 on line 16 in terms of suite renovations. Is that where you're coming from there?
I'm sorry, can you repeat that?
On page 11.
Page 11, yeah.
191 Roche, the sales questionnaire below. The purchaser on line 16.
Yeah.
You mentioned that this property should be used for any sort of cap rate analysis because there was an indication of suite upgrades for $100,000. Is that where you're getting that information from?
No, it says that, so we have the municipal board order saying that any purchase made with the intention to renovate ought not to be included in a cap rate study. Now, I suppose what you're going to ask me is if $100,000 on a purchase of this size is a substantial investment, but that's $100,000 in that period. We don't know what's transpired since then. So what we do know is that the purchase was made with the intention to renovate. So it does not recognize the post-renovation income, and it does not typify the typical motivations as stated in the municipal board order that's included in our evidence here.
So on page 9, the same municipal board order says, second paragraph, the big one, about halfway down, the board does not accept that any intention to renovate should disqualify a property sale. A renovation must be of significant financial investment on the part of the property owner, one that will cause future rents to substantially increase. It should usually involve modification of the building envelope or realignment of the structural walls. The amount that they indicated was $100,000 is calculates to 2.77% of the total sale price, and they indicated suite upgrades.
Right. That's,
So I have two questions.
Mhm.
Is 2%, 2.5% significant in your mind in terms of intention to renovate, and do they do any modification of the building envelope and realignment of the structural walls? Do you know?
okay, so that 100,000 that we're talking about, that's not necessarily comprising the entirety of what they've done to that building since purchasing it. That's, is 2% substantial? No, but they clearly purchased it with the intention to renovate and to drive the rents up. So that cap rate that you're deriving is inappropriate. That's the spirit of this order.
On page 12, on line 32, they purchased the property based, the question was asked, was the property purchased based on its net operating income? They checked off yes and said the cap rate was 5%. Is it not possible that, in fact, properties are purchased based on their income in place at the time, despite the fact that there may be future aspirations to fix the place up?
This purchase was made based on the ability to see the economic upside to it. So if they see a property that can potentially be purchased, repositioned in the market, and drive higher rents, then that's more of an internal rate of return or a discount rate versus what we would use as a cap rate in a direct cap exercise. And I think that's what the municipal board has ruled on. They're saying we can't use these because they do not capitalize the income in place.
Is there any evidence of further renovations other than the potential declared?
I'm not sure.
Okay, those are my questions.
Thank you. Ms. Nesbitt, questions of the assessor?
No, my question's related to capital as well.
Mr. McIntyre?
I have no questions.
Mr. Barakis, did you get a chance to look at the apartment building? No. So I looked at the pictures, etc. The cap rate seems to be, it's at 4.8%.
Yes.
It seems to be rather low based on the condition of the property. So what are your feelings in that respect?
If the property is in original condition and Wellesley, it seems like it's got a lot of potential, a lot of upside to it. Just because property doesn't have anything brand new, and it doesn't mean that it's not a good investment. That's why we're seeing sub 5% sales, and it's declared in sales mailers by the purchaser, which you're going to see in a little bit. For properties that aren't 333 ward. 333 ward's not the basement in terms of cap rate.
The property was sold in 2020.
Yeah,
Okay. It's post-reference.
that's post-reference.
Okay.
Yes.
And I don't have the screen in front of me here. What was the transaction price?
I don't think I can say that actually.
Okay.
Because I'd like to,
But wasn't it in the brief somewhere?
it's in my brief.
Okay. So if it was in the brief,
It shouldn't have been. I should have.
it shouldn't have been.
crossed it out,
But you can tell us if it was in the brief. I can't find it offhand, but if you don't mind, I'd like to have that information.
yeah, it's on page 2 of my brief.
Okay. And can you tell me what the figure is?
952,000.
Okay. And with it being post-reference, did you extract maybe a cap rate?
That had nothing to do with it.
Okay,
No.
you didn't?
No.
Because it's post-reference.
And there was no other side. I should have crossed that out.
All right, Mr. Story, we're ready for your presentation.
Perfect. Thank you. Okay, 183 Maryland. So we've got 11 one-bedroom suites. We're looking at a reference date of April 1, 2018. With a 2021 realty assessment of 761, we are requesting 562. Now again, we're on the east side of Maryland between Sarah Avenue and Broadway. This is the West Broadway area. We've got again, it's 2 stories, under improved with a gross floor area of 6,357 square feet. Site size, according to the city of Winnipeg, is 6,151 square feet. Again, 11 one-bedroom units, 8 outdoor parking stalls, and I will suggest to you that the property is in objectively poor condition. I visited the exterior and I have photos of the interior. So effectively, at this point, the property did change hands. So in terms of the NOI, we have accepted the model, though I can tell you that in the past, the actual rents were $5.55 a month. So regardless of how desirable you think it might be, the rents are quite low compared to the citywide average for one-bedroom rents. So there's also extra parking revenue that comes by way of parking at $20 a month. But because we don't have the history of mailers, the property has changed hands. We are using the NOI provided by the city and a cap rate of 6.5. I will point out too that post-reference sale, we don't know anything about the details of that sale, if it's a share transaction, if it's a portfolio sale, so I do ask that that be disregarded. So for the purpose of this report, the main issue is the cap rate. The assessor is using a cap rate of 4.8%. We're using 6.5% based on our study. Now, typically, a property built between the age bracket of 1960 and 1979 in a good location, in good condition, would typically be applied a cap rate of 6%. Based on the objectively poor condition of this property, we have applied 6.5%. Again, bringing us to 562 rounded, and we do respectfully submit that this the value of the property be adjusted to $562,000. If you follow me, we're talking about the condition of this property. You can see on page 9, these are photos submitted by the owner and taken in January. So this is very close to the present physical condition of the interiors. You can see the kitchen, that's original parquet, builder grade floors in the kitchen. The cupboards are in, again, objectively poor condition. See what the bathrooms look like. Interior corridors, that would be original to 1969, I would suggest. And then you can also see the storage in the basement as well as the laundry area. So with all these factors taken into consideration, we do suggest that a 6.5 cap is appropriate. Just for the sake of discussion, I have included the City of Winnipeg crime map. This is an area where crime has been on the rise at the reference date. At April 1 of 18, we see that there's that's where the beginning of the property crime that we've all read about and heard about in the news starts to begin. And then I've included census data. This is the most current census data of 2016. And basically what that shows you is that the median household income in this area is less than half of the city's median household income. So this does suggest that we have an economically depressed area that is not necessarily attractive to investors. So again, with all these points taken into consideration, we suggest that a value of 562 is fair and equitable for this the 2021 assessment year. Thank you very much.
Thank you, sir. Ms. Barocas, questions of the applicant?
I got some rebuttal cap rates. I think it's in the file folder now. I got 2 paper copies here as well. So if you go to the first one, it says,
I'm not sure we have it.
it's not, it's in the
What
bottom.
does it look like? Can you just show us the front page?
This is the first one. So the first, that's the first one on the top of the list, A&T Rebuttal 1, cap rate study. So if you open that up, I know I've put this across the desk before. This is just in regards to the Altis cap rate study, which wasn't presented. So if you go to page 5, it's highlighted, line 32. This is in regards to 210 St. Mary, which is the first property on the Altis cap rate study list. Altis stabilized the property at 6.25. What the rebuttal says is that the property was purchased based on its net operating income, and then he used 5.5 as a assumed cap rate. And then the last property, 718 Beach, the last page shows a 4.5 cap rate, but that's page 7. Line 32 says they use a 4.5 cap rate when they purchase their property, and if you look at the Altis cap rate report, they calculated it at 5.42, which is almost a full percent higher. So it's just showing that what purchasers are assuming cap rates are out there is not what Altis stabilizing their figures to generate. There's that part of the rebuttal. Maybe easiest if he asked me questions based on that, because I have some more. It would probably be easiest to just do that.
Sorry, I'm just trying to make sense of this here. Okay, so you're suggesting on page 5, so there's no calculations here. There's nothing, you've got to.
That's what they declared, yeah.
Yeah, okay. Now, do you know, is that done on the discounted cash flow method, or is that direct cap?
There was no indication how they generated that cap.
Okay. And same question for this one on Beach.
Same answer.
And do you know who filled this form out?
For Beach.
Yeah.
The owner.
Is it a valuation professional?
I don't know what their designation is.
And then you've also got this. You got a slideshow from the.
I haven't talked about that yet. I'm going to talk about that after.
Okay.
I was going to let you ask questions about this first.
Okay. Well, why don't you present everything, and then I'll ask you questions about
Okay.
the entirety of your presentation.
Okay, file number 2 of the assessments. Rebuttal, real estate form. So basically what was found on the computer here is first page from the RBC Convention Center, May 30th, 2018. Shows it was taken from the website. Altis put on a presentation in regards to the market. So if you go to page 12, scan down to page 12, you'll see that Altis presented in a presentation showing historical cap rate information from 2008 to 2017, showing cap rates below 5% since 2012. I wonder why those figures aren't in their cap rate study. And the third file of the rebuttal shows I basically plotted their stabilized numbers against that chart on page 12 of the previous file. So if you open that up, you'll see that every single property they selected is above what they were telling people at the Winnipeg Real Estate Forum during the presentation, what the cap rate trend and figures were. So there seems to be a discrepancy in regards to what Altis is presenting colleagues outside of the border vision and what they're telling us here. That's my rebuttal.
Okay. So you do understand that this is the valuation, the appraisal side of Altis that did this presentation, correct? And you're presenting this chart without context. We don't know what was said, but is this for the purpose of financing?
It says historical cap rate.
Were you there? Did you see the presentation?
No, I didn't.
Okay, so you have this out of context graph, but what tips me off is that we're talking about the 10-year GOC bond rate comparison. So we're likely talking about a discounted cash flow analysis, correct?
I'm not looking at bond rates. We're talking about cap rates.
It's included on page 13 of this, the average cap rate and the spread between the GOC bond rate. right? So that's typically what we look at when we're doing discounted cash flow analysis for lending purposes. But we're not doing a discounted cash flow analysis here. We're doing a direct capitalization. So it's the difference between assessment and appraisal, correct?
I'm looking at market value here.
Okay, well, that's fine. Yeah, those are my questions. Thanks.
Mr. McIntyre,
No, I have no questions.
Ms. Nesbitt?
No question.
Your gross rents and your NOIs are exactly the same. So it's just a question of cap rate.
Cap rate.
Mr. Barakis, summation if you want.
I mean, I've talked about the cap rate study itself and the problems in regards to the really low years of R&M all last season that were included. If you start at page 10 of the PDF and scan through, you'll see numerous repair and maintenances stabilized under 1,000, many times under 500. You'll never see those numbers on the application side when they go to stabilize their figures to calculate a value here. Great example is 210 Balmoral and their figures, 210 St. Mary's, 2016, they include a year in their average, $959 for a living. That's double digits on a per unit basis. It's inappropriate to use low figures like that. So, I mean, you've heard me go through these questions before, so I'm not going to beat a dead horse here. That's my summation.
Mr. Story?
Yes. Just very quickly to put this all in context, the burden of proof is on the assessor. The assessor has provided no cap rate study, no cap rate information to speak of, no calculations, no supporting documents. We've provided you with a full cap rate study, and we see comps that are in this area, this vintage, very similar, and they're all transacting above 6%. So I would suggest that we've done a voluminous cap rate study here, and the city has not really provided much of anything for us to look at. So I do suggest that our 6.5 cap for a property in this area in this condition is appropriate. Thank you.
Okay, thank you. We're going to take about a 5-minute break. So we'll shut down the camera and. Okay. Call a hearing back to order, and we're going to go to 190 Belmoral Street. So, Mr. Barakis, whenever you're ready.
File 20-504, roll number 12091267000, 190 Belmoral Street, 2021 roll year, assessed value $1,618,000. Built in 24, that's got an effective year built on it, based on renovations that were done. To the property, 18 suites, no parking. Just skipping ahead quick, it looks like we're pretty close in terms of this property. The net operating income, the applicant's actually about $5,000 higher in terms of net operating income. Page 2, you see they've been compliant with their request for income information. And page 3 shows the modeled workup showing net operating income of $82,000 on it. If you look on page 7 of my brief, they are declaring for 2017 $85,000 on the net operating income. So it looks like we're okay in that respect. Properties in the same sort of area. This one's north of Broadway, actually, almost south of Broadway. Same general area as the last property. So I think this one is predominantly, again, cap rate. We have at 5.1 as panels per cage area and size. That's my evidence, thank you.
That's your presentation, sir?
Yes.
Okay, I thank you. Mr. Story, questions?
Yes, thank you. I guess first, have you visited this property?
No, I have not.
So the actual year built was 1924, so that's almost up to that 100-year mark. The effective year is 1970. Now, what precipitated that change?
Well, I just Googled 190 Balmoral, so if people want to do the same, you can see what's happening there. You can see that they've described it with pictures, completely rehabilitated, gorgeous, stylish, modern walk-up. Wired for HD and Wi-Fi, gleaming hardwood floors, professionally designed kitchens, include custom cabinets, generous counter space, black appliances, double porcelain sinks. So just looking at the pictures here, looks like they redid the place pretty nicely.
So you're Googling the marketing material, is that correct?
Yeah, well, I would have looked at this beforehand. You asked me where the effective age come from, and I am just reading off their ad right now and looking at the pictures.
Okay. All right. So now that's Class D construction. That's wood frame, correct?
Yep.
The building, and I note here it sold 4 times in 10 years. Is that typical?
No.
That pose a risk to the next potential investor, do you suppose? You don't think so? Okay. All right. Now this 5.1 cap, this is all modeled, is that correct?
Yep.
Okay, and so the model generates this and then it's accepted. There's been no overrides to any of these inputs, correct? Including the cap rate?
No overrides.
No overrides, okay. And now again, we talked about your cap rates. They're depressed by intention to renovate, but again, now you might not agree with my cap rates, but you have included the broker's table. And again, I'm going to suggest to you that this is a low-rise B. So if the brokers are telling you that it can't be lower than 5.75 and a good quality location, good quality asset would be a 6, then how do we come to 5.1 in the city's assessment?
Based on income and expense mailers submitted to the city.
That's how you derive the cap rate?
Yeah.
Okay. How can you possibly do that? You need a sale price and you need an NOI to come to an imputed cap rate.
We model it based on the income and expenses submitted to us, and then we come up with categories.
Okay. All right. And suppose those are my questions. Thanks.
Thank you. Ms. Nisbet, questions? No? Mr. McIntyre?
No, I have no questions.
Mr. Barocas, the subject property is fully renovated.
Yeah, definitely.
Work permits taken out? Permit,
Oh, you know what?
not there?
I don't have them. I don't recall if they were or not. They should have based on the level of work they did.
So that would have been substantial to,
That would have been
ideal.
ideal, but again, there's a lot of, it's been renovated. It's not a question of whether it's been renovated.
It would have been helpful to know the,
Well, for instance,
dollar value.
you can look at page 11. You can see comparing it to the rents that the last property was receiving. You go to my page 11, you'll see there's rents in excess of $900. Last go around, they're in the $500 range. There's definitely quality difference to garner those rents.
So in your cap rate presentation here, I see you have 4 properties, okay, in there. And, you know, a little bit of range there from, you know, from 4.03 to 5%. I guess just looking at the suite count, the subject property is 18, eh? Yeah, it is.
Yep.
So, so I'm thinking that possibly you could have come in at a little lower cap rate for the subject rather than the 5.1.
I mean, these are just 4 examples. There's other sales out there as well. The way it was modeled at 5.1.
But, you know, taking into consideration, you know, the subject property is built in 1924, but it's got an effective age of 70.
Yeah, definitely.
Do you know, in your study here or in your presentation, do you know if these have been, you have the effective year built, but you can't really tell me whether it is an effective or whether they're older or anything like that?
I don't have the actual year, I just have the effective year.
And this is, would you consider Wolseley area or Belmoral? You know,
Wolseley,
yeah.
West Broadway. This one's a little further away from the
Yeah.
Wolseley strip.
Yeah. So,
So I would say the other location.
is Maxwell close to the subject property?
None of these properties
No,
are close to the subject
Because,
property.
yeah, Roach and
Mhm.
Talbot, East Kildonan. All right. Mr. Story, we're ready for your presentation.
Thank you. And Mr. Chair, I do have photos of the interior that I took. I conducted an inspection on August 26th. So I know that's new information, but if that's amenable to you, I do have paper copies, and they were submitted to the secretary prior to the hearing.
Well, it's sort of after the fact.
That's when we could go in and do a physical inspection to determine the physical condition. But
Mr. Barocas, would you like to look at those?
sure. Are you going to pull them up, or do you want to?
Sure.
They're in there now. The photographs are in front now.
Oh, they're in here?
Yes.
Okay.
Go back to the directory.
Directory, the folder?
Yeah.
Okay.
And PC photographs.
Okay. Matthew, do you have this too? You want to take us through that?
Sure. Yeah. So effectively, this past Wednesday, I went through the remaining properties on our docket with the owner. Spoke to the owner about her concerns with the properties. For what we call the most typical suites. So we didn't look for the suites in the worst condition or the best condition, but the most typical suites. We looked at a minimum of 2 suites per property. Did an exterior check on the buildings, as well as obviously the interiors. So I have been inside of each of these buildings that are remaining, inside the suites and in the common areas. So first photo, you can see we're talking about an age variance that's rather large, but effectively what's happened is some of these suites have been upgraded with, they've been painted and they have plank vinyl flooring. So suggesting that we adjust the effective age by 50 years based on cosmetic work is inappropriate. The building is certainly from the 1920s. So suggesting that it's from the 1970s because we've done cosmetic work in the suites is not appropriate in my mind. The work that's been done subtends the rents. The rents are what they are and they're not in question, but the cap rate based on the numerical assessment of risk is based on the remaining effective life of the asset. And this building is, no matter what you do to the flooring, is still built in 1924, and it is a wood frame building, and it is in West Broadway. So those are the photos. I leave them with you to peruse. And of course, there's always a gap between marketing photos and marketing language and what is actually going on, obviously. So I would suggest that we try not to rely on marketing photos and language when determining the effective age of an asset. So may I continue with my main presentation? Okay, thank you. So we're at 190 Balmoral. Again, the building is built in 1924. It's a 3.5-story walk-up. It has 18 suites, 4 bachelors and 14 one-bedrooms. I did confirm with the owner that the one-bedrooms are the most difficult to rent in their portfolio, largely because there's a basically the cost differential between the one-bedroom and the bachelor is it's a value proposition for these assets. They're not commanding high rents because they're desirable. It's based on budgetary concerns for most of the tenants. They tend to have very high turnover. They also have the vacancy is not a huge issue, but they do have damages when tenants leave. And given the area, there's a great deal of nuisance behavior that comes about that is inherently risky in owning these properties. We note that the windows are an issue, the back alleys. If you go through any of these alleys, there's mattresses, there's all sorts of general detritus. And then the new issue that they're having is people are breaking into the mailboxes. So I will suggest that there's a far higher risk when an asset on in East Kildonan or even in South St. Patel. So we do factor that in when we're doing a site-specific analysis of these properties. So again, we're on the west side of Balmoral. We're between St. Mary and Broadway. This is West Broadway. We've got a gross floor area of 13,108 square feet, and the site size is 4,468 square feet. And we have no parking associated with this property, which we note. Again, the main issue here is the cap rate. We have used the actual income and expense mailers where the city has used a model. We've stabilized the last 3 years of income and expenses to determine the income as well as the expenses and the expense ratio. Our expense ratio is slightly lower than the city's at 47.5% versus the modeled 49.7%. But we do argue the cap rate the city is using an aggressively low 5.1 cap on this asset, where we are suggesting that an asset of this age in this location should be applied 6.25. So with all those factors taken into consideration, we suggest that a market value of $1,402,000 is appropriate. And I have included some of these same marketing images that you're looking at. And it is interesting to note when you look at the photos that I took myself, the marketing images, these are staged properties. These images are they're altered, quite frankly. They're color corrected and they're professional photographs. They're not necessarily the best indication of the suites. So, and then I've also included the permits. So we see that in the last, since 2003, we see some wiring that's being done. Oh, I'm sorry, that's page 9 of my brief. So we see some wiring, drains only, minor repairs, electrical, interior alterations, and some exterior repairs in 2011, which is, I'm guessing that that's probably what precipitated that change from 1924 to 1975, but we don't see any, we see interior alterations, but I don't know if that's structural. So effectively, with all these points taken into consideration, we do suggest that the value not exceed $1,402,000 for the 2021 assessment year. Thanks.
Thank you, sir. Ms. Barocas, questions of the applicant?
Do you think this property is in a desirable area?
No, I don't.
Do you think owner would renovate a property to this extent if they didn't think there was a good return on it? Return on renovation?
I think that the owner owns this asset, and in order to subtend their rents, they have to maintain it to a certain standard in order to curb vacancy and maintain their tenancy, like any other apartment building.
Would you be fine if the panel looked at the color images, marketing images that I just Googled?
Those are included in my brief, but if you'd like to Google marketing images, then
Just colored ones,
I'm sorry.
just the colored version, because it says a lot more about the
Mine are in
quality.
color as well. They're in my brief.
No, these ones, the paper ones?
No, the ones that are in my brief, they're in color. I've got all the same marketing images that you just Googled. I looked at them before. They're clearly marked as marketing images starting on page 10 of my brief.
You're right, okay. Do you think the R&M and the Altis cap rate study overall is a little bit on the low side?
I think the R&M in the Altis cap rate study, the R&M for this property is $1,302 per suite.
I'm talking about the Altis cap rate study, stabilized amounts. Like for instance, on 210 St. Mary's, you included a year.
Yeah.
$959. Would you include that on a subject property side in the stabilization of repair and maintenance, or might that be excluded?
Well, I think that's probably low, but what you're going to find with that is that the rents are also low. So if you're trying to isolate any of these inputs, you can't. You have to look at the other inputs that correlate to them. So if you have higher rents, you've got lower vacancy. If you've got higher R&M, you might have higher rents, right? So to isolate one and not adjust the other parts of that picture is inappropriate.
So it's normal if you have lower rents, in your opinion, to spend $959 a year on repair and maintenance. That makes sense. You would include that on the.
Sorry, I can't hear you.
If it makes sense because on 210 St. Mary's, you've got low rents, in your opinion, that it was appropriate to include a year of $959 repair and maintenance in your calculation for R&M, average R&M, for the purpose of coming up with a 6.25 cap rate. Is it appropriate to
That's
use?
what the expenses are in that building.
Do you ever exclude expenses for being too low or too high?
Well, sure, you look at anything that's completely atypical and do a specific analysis to be certain.
Okay, so $959 divided by 11 units is $87 a unit. Is that typical? Should have that been excluded?
Clearly, that's a low year. Yeah.
Would you have excluded that if this property was under appeal on the application side?
I think we'd likely stabilize that into a more. But if you're looking in this area in our cap rate study, we've also got. Let's pull it up here since you're. My point is that you'd have to change every input if you change one. So if we look at Langside, for example, right, that's a 6.12 cap. That's a comparable property, right? Balmoral is a comparable property. So we're not seeing 4.8 or 5.1 caps for these older properties in the inner city. That's the point. So is $900 low? Of course. Does that mean that the cap rate ought to be 4.8 or 5.1? No. We're seeing cap rates north of 6% for these types of assets.
If you stabilize the R&M higher, what would happen to the cap rate? Given all the other numbers stay the same.
But they wouldn't stay the same. That's the point. They don't stay the same. They're not static. You don't change one and then the rest of them don't change. If you change the R&M, you change the rents as well.
No, you don't.
Well, yes, you do.
The rent doesn't change.
You'd get higher, you would achieve higher rents if you spent more money on the repair and maintenance of the building.
The other years they were spending less than $1,000. Is that enough to change the rents on the building?
No, we're talking about valuation theory in general. If you spend more on R&M, you're likely going to increase your rents.
So spending less than $1,000 per unit, which you never see on the application side, is that enough to change the rents?
Sorry, spending, is it,
So you're saying you spend more on the application side?
if you spend,
If you spend more on the repair and maintenance side, you saying the rent goes up?
theoretically, the rent should go up.
Okay, so with rent control, you have to spend a lot of money and do a lot of renovations, capital improvements in order
Not
to get the
capital
higher
improvements to
rents.
get, no, you don't do capital improvements to get above the rental board. Capital improvements are excluded when you're trying to get above the rental board.
I think the board gets what I'm saying. Thank you.
Nothing further?
No, that's it.
Okay, I thank you. Mr. McIntyre,
I have no questions.
Ms. Nesbitt,
Yeah, I have questions.
I guess it boils down like in the majority. I'm sorry.
Question. I do have a question.
Oh, I'm sorry.
Yeah. Mr. Story, I'm looking at your page 6.
Yep.
Your chart.
Sure, yeah.
Where do these numbers come from?
So we've provided you with this cap rate study.
No.
Right. Oh, I'm sorry, this is page 6. I'm sorry, my workup. These are from the income and expense questionnaire. So they're included at the back.
Okay, that's
Yeah.
fine. A lot of these numbers are just repeats. I'm just looking at, not so much on your income side, but on your expense side.
Yeah.
Exact same for office supplies, bank, blah, blah, blah.
Right.
Exact same for advertising.
Yeah.
Within $100, $200
Yes.
for utilities over 3 years. Exact for waste. So are these budget numbers or the actual numbers?
These are budgeted by the owner. So they have a 25 property portfolio and they have a, they budget them. So sometimes they're higher, sometimes they're lower, but we find with this portfolio that the actual NOIs come out higher than the model
They
numbers.
do.
Yeah.
They do for sure, and that's fine, but I'm just wondering, because the numbers are pretty much the same, they don't really deviate.
Yeah.
So I was just trying to understand, I've seen Altis that says
Yeah.
these are actuals, these
Yeah.
are not actuals.
These are the actuals that were reported by the owner, but they are, they're
They're
modeled on
actually-
their budget. Yeah.
They're actually reported, I
That's what they're
understand,
reported, yeah.
that's the numbers they submitted
Yeah.
to you. But from backing that up, they're
Yeah.
not actual expenditure numbers.
No, they're not actual, they're modeled based on their budget.
Their model numbers as well.
Yeah.
So your model is based on their model, which is a model,
Well, sure.
essentially.
Essentially, yeah, it's the way that they have a budgeting formula that they apply to their portfolio. And this is,
Is that a normal practice?
well, I mean, is it a normal practice? It's,
Is it a typical practice?
no, and I think that typically I don't tend to see the NOIs coming out higher than I don't think it's necessarily beneficial to the owner, but I think that it's probably a way for them to submit all of their income and expense questionnaires in that short period for their 25, 30 property portfolio. So I don't think it's necessarily beneficial to them. But is it typical? No. I think it's might be an ease of use scenario for them. It might be easier for them to report it this way.
Not necessarily as accurate as using actual.
No, it would probably be to their benefit in terms of how we do come up with this
That's
assessment.
fine.
Yeah.
Mr. McIntyre, are you okay?
Staying on the same page,
Okay.
I see in the far right-hand column under remarks, where there were identical expenses, these appear to be the average between the 3 years.
Oh, that's our form. Yeah, so it's,
using mostly the
but actually no, but it is still an average.
So
But it's
is
the
it?
same number.
It's the same number, yeah.
Yeah, but is it the sum total of the expenses in those 3 years divided by 3? So they've applied it every year.
Oh, okay, so, sorry, if we're looking at, for
They were
example,
looking at office.
Yep.
Bank and the 2160.
I mean, that is,
So when I see that remark average 2015 to 2017, it leads me to believe that they've totaled the 3 years and then just divided it by 3 and
that's
split it.
the background formula in the Excel spreadsheet, yeah. So typically, a different client might say, well, we spent 1,800 this year, 2,100 this year, 1,900 this year, and then it would generate that average. But because it's the same inputs, it's effectively adding 3.
It's actually actual.
It's an actual average of what they've reported, yeah. Yeah, it is.
Based on a modeled number.
Yeah,
But yet the other expenses aren't based on a model number.
which ones?
Like if I look at insurance.
No, insurance that's a real number. That's an actual, yeah. But things like, sundry or office supplies, things like that, they just make an assumption that it's X amount per building per month or whatever the case may be.
I guess the one that struck me was the fact that the utilities are not a whole lot higher over the 3 years.
That was all my questions.
Mr. Story, the city's at 5.1 and you're at 6.25. So, but you have a totally renovated building.
Well, I don't know that it's
So-
totally renovated. I've been in this building. I can tell you the hallways are not renovated.
Okay.
Not every suite is
The
completely
suites,
renovated.
the suites
The,
are.
the suites are painted and they have plank vinyl flooring in them. So,
But
sure, they're
according
not,
to the pictures, they look pretty nice,
well, that's the purpose of a marketing photo,
Yeah.
is to make it look desirable. And that's reflected in the vacancy, and that's reflected in the rents. The cap rate is the perception of risk. These properties in this area require a great deal of hands-on management. There's a great deal of turnover. I've seen these suites at turnover. They have to repaint all of them. The damages are often far in excess of the damage deposits. There's collection loss that has to be forwarded to collection agencies. There are people who leave the suites in a terrible condition, and there's no recourse. So the physical condition that subtends those rents is one thing, but the risk profile of these properties is completely a separate matter. And I'll suggest to you that the location is a big part of this, and that's not my feeling. That's reported by the owner and multiple owners in different multifamily res units that I handle. So I understand that this is it's a difficult place to be an owner. It's not like a South St. Hotel. It's not like the suburbs. There's a greater degree of hands-on management and risk. So that risk has to be captured somewhere. Cap rate is the numerical expression of risk. So the cap rate is where we capture that.
Thank you. Mr. Baracus, summation if you so desire?
Nope.
Mr. Stories,
They were good.
summation? Okay, we'll go on to 53 Kirby Street. And Mr. Baracus, the floor is yours, and you are seeking, I think, a increase in regards to the assessment?
Okay, so for this one, it's my first time asking for this, but I
Yes.
didn't mail it out correctly. It was supposed to go to the applicant too, so I'm just asking that it be maintained, because
Okay.
protocol was not followed.
The procedure is, I can't remember exactly.
I talked to Brian about it afterwards,
Okay.
so then we just ran out of time.
But you have to give notice.
Yeah, I filled it out and I sent them
Okay.
mail out, and then one bounced back, and then I was supposed to also send it to Altis as well.
All
I
right.
found out postmortem.
So then we'll just proceed according to the evaluation. So the floor is yours.
Okay, so file number 20-505, roll number 120906721, 00053 Furby Street, roll year 2021, reference date April 1st, 2018, has an assessed value of $1,179,000. This property was heard at the Board of Revision already for 2020. if you go to page 11 of my brief, you'll see that it was lowered from 1,310,000 to 1,179,000. So it's been heard already. They used it based on the applicant's NOI and a 5.5 cap rate. So I was planning on asking for it to go back up to the original value. So I can't do that. So I'm just asking that the value that was previously decided upon be maintained at 1,179,000. It's been heard before. Details have been heard before. There's any reason to change it. Property is in Wolseley. It's the end of Wolseley Avenue as it intersects with Furby. It's an apartment, 1979. It's got a 1989 effective age on it, based on work that's been done on the property. Just glancing ahead of this one, I believe the applicant, his NOI is actually higher than the NOI the city's using on page 3 to generate our assessment using the 4.7% cap rate model again. So I'm not going to go into the financials too much. It appears this one's cap rate issue as well. Sorry, I haven't. So there's been some work done to this property as well, just looking at the applicant's photographs. I don't have details on the renovations, but that's where the effective age is coming from. It's not original to 1969. So 1989, for this size, vintage, and area, I guess the 4.7 cap rate, it looks like on the net operating income standpoint, if you go to my page 7, they're reporting 63,437, and our net operating income for the higher one I was originally seeking is 61,559, which is lower than the applicant. So again, it's just a cap rate issue on this one. That's my evidence. Thank you.
Thank you. Mr. Story, questions?
Yes, okay, so now, so the increase question is off the table, so I suppose we can leave that alone. Have you visited this property?
I haven't visited any of the properties.
Okay. All right, but there's a 20-year variance, and can you tell us what that's based on?
Renovations.
And can you tell us the extent of the renovations?
Looks like they have pictures of some work on the kitchen. Can't really see the bathroom. There's some new doors on the property. They've done work on it. I don't have the notes, unfortunately, or permit.
Okay, so is it the city's view that cosmetic work to the interiors of the suites affect the actual age of the building?
Effective
I
age.
should say the effective age,
Well, so they did some new cabinets, backsplash. Just looking at your picture here. They did work. It looks like in terms of income, what are they getting? 123,000. We're understating the income. With an effective gross income of 115,000. The effective age is used to calibrate what sort of rent is set in our model, so it doesn't look like we're overstating the effective age.
And does the effective age, that affects the modeled cap rate then as well, doesn't it?
Yes.
Okay. So we don't know what the terms were for the age variance besides some you said some cabinets and some interior cosmetic work, but that comes to bear a substantial effect on the assessed value, correct?
Well, we look at the income and expense mailers they submit, and we want to put the property in our model in line with the way it's actually behaving, because we don't want to overassess the property.
Right, and we don't apply any sort of adjustments for location for our cap rates from the city, is that correct?
Not for this area.
Not for this area. There used to be adjustments for Centennial, the North End, and part of the West, correct?
Market Region 7 and Market Region 4.
7 and 4, so that's the North End and then the tracks? So
The North End
Logan
and
CPR.
then
Okay.
the West End.
Logan
South
CPR,
Tracks, yeah.
Okay. Now, on page 3, this is an incorrect workup based on what we're talking about today, correct?
Yeah, I meant to bring it back to what we had
Okay,
before.
so you don't have the evidence here. Just so you haven't visited this property, but you're aware that this is down the street from the back of the Sherbrooke Hotel beer vendor, correct?
Yes, actually, I'm aware of that.
Do you think that might be a negative influence on this property?
Could be, honestly.
Yeah. Okay, those are my questions. Thanks.
Thank you. Ms. Nesbitt, questions?
I have no questions.
Mr. McIntyre?
I have no questions.
I have none either. Mr. Story, the floor is yours.
Thank you very much. Okay. Again, we have a property built in 1969 on 53 Furby. It's a 2-story walk-up, 12 one-bedroom units. So this is the east side of Furby, north of Wolseley, and north of the Wolseley and Furby Street intersection. Again, the city is applying an effective age of 1989, though it was built in 69, presently being used as a multifamily residential building. And again, 12 one-bedroom units. So in the interest of narrowing the issues, we're really only talking about cap rate here today. That's the cap rate is the issue of the day. So we are, for the purpose of this assignment, we are using a cap rate of 6%. At the time of creating this brief, I didn't have the assessor's correct workup, but regardless, we use 6% for this type of property. And keep in mind that we do recognize that there was some work done on this property that was cosmetic. It is in reasonable shape on the inside. The location is a factor. So a property built between 60 and 79 is applied a cap rate of 6% in our study. So we think that 6% is appropriate given some of the factors discussed. So with that in mind, we come to a total of $1,087,000 and do respectfully submit that the assessment be adjusted. Now, there's an issue where in 2020, a different applicant, a different firm from ours, handled this property. So that's why typically we would not appeal the second year. A different applicant appealed this. I've included their brief. It is it's a hearing de novo. It's all new information. The way their cap rates were derived were different from ours. The sales were different. There was an equity argument, and I believe they were asking for caps somewhere in the mid 7s. So it is a completely different applicant. We do ask that it be heard again based on the fact that it was not our information. And so that's just in case that does come up. I do want to point that out. I have included their submission just on the public record, just so in case you're interested to see where we differ. Effectively, their cap rate is a ways off from ours. So again, we're suggesting a cap rate of 6%, bringing us to an estimated market value of $1,087,000. Thank you very much.
Thank you. Ms. Baracus, questions?
No questions.
Mr. McIntyre?
I have no questions.
Ms. Nesbitt?
No questions.
Submission to the party?
I do have photos there as well with the other ones, and I did visit and took photos, so you should have them in your folder should you wish to peruse them. But they are there. There are photos for all the remaining properties. Forgot to mention.
Anything further, Mr. Stark?
No, thank you.
Okay. We'll go on to 181 Maryland Street. So, Mr. Baracus, again, you're seeking an increase. And
Same issue as
Same
before.
issue?
So we're just
So,
we're asking
okay.
for maintenance on
So
this
the
one.
floor is yours then.
Okay, file number 20-507. Rule number 12090400000, 181 Maryland Street. Assessed value $1,033,000 to 1955 with a 1972 effective year built on it. 11 suites, 8 outdoor parking spots, construction class D, wood or steel framed walls. So for this property, again, this one was heard on page 13. Same story as the last one where they reduced the property based again on the NOI of the applicant, and they used a 5.5 cap. So like the last property, this one was heard already, and they used a 5.5 cap. Our net operating incomes are similar. Applicants at 55,000. We are at 54,000. So we're within $1,000 of each other. Cap at 420 is just based on effective age, area, and size. So again, it's a cap rate issue, similar area. That's my evidence. Thanks.
Thank you. Mr. Story, questions?
Yes, yeah, okay. So you have not visited this property, is that correct?
No, I have not.
Okay, and you've got an effective age here.
Mm-hmm.
Did you review any permits to see if that adjustment was appropriate?
Probably, yeah.
Okay. All right. So again, there are 11 suites and it's Class D construction, so it's wood frame.
Mm-hmm.
And wood frame comes with extra risks to an owner. Is that safe to say? Generally, there's structural risks with wood frame that we don't see in something like masonry, perhaps.
Masonry is more solid.
Now we don't have the workup again.
No. Again, I was trying to. My intention was to raise it, but I didn't find out until after the evidence was submitted that the procedure I followed.
Right, but even if you did follow the correct procedure, shouldn't you show the workup that we're talking about today versus the one that you're pursuing? We should be able to see what the base assessment is, correct?
I don't see how that's relevant.
We need to talk about the parameters at play here. Okay, that's fine. Now the first property that we talked about was 183 Maryland. That's right next door to this property, correct?
Yep.
Okay, and presumably this property has based on this current assessment, is about a 5.5 cap. Is that correct?
Yes, that's what the board decided on.
Okay, and the property next door is in objectively worse condition, and you modeled a 4.8 cap on it. Does that make sense to you?
Cap rates are assigned by the model based on age, size, and area.
Right. Okay, and so, but again, just to reiterate, we have no supporting evidence or no supporting documents for your cap rates.
They're all modeled.
They're all modeled. Okay, so there's presumably a model somewhere where a number of properties are fed into the model, and then it spits out this cap rate table, correct?
It's there. It's not presumably there. It's
Okay,
there.
but it's presumable to us because nobody can see it, correct? The ratepayer is never disclosed to the ratepayer. For example, how many properties are included, the areas, if they're high rises, mid rises, low rises, the vintage, the quality. None of that information is made available to the ratepayer. Is that correct?
That's correct.
Okay, and then we look at once again, we go to the brokers table, and we see that for a low rise A or B investment grade, which is superior to the property we're looking at, they're ranging 5.5 to 6, but you're saying that this property falls below that in terms of its risk profile. Is that correct?
That's what the model said.
Okay. And would you ever change the model if you thought that it was incorrect? Would you ever override the cap rate of the model?
No.
No. Are you able to?
Am I able to?
Is an assessor
Well,
able to?
I could type, yeah, I could, but no, I'm not overriding the model. That's what everyone else who's not appealing is getting, sort of for the purposes of the equitability of the tax burden, because ultimately what is being decided here, I'm not changing the cap.
We don't actually talk about equity though, do we? We talk about site-specific analysis.
I'm just giving you my reasons.
Okay, those are my questions, thanks.
Thank you. Mr. McIntyre?
I have no questions.
Ms. Nesbitt?
I have no questions.
Mr. Story, the floor is yours.
Thank you very much. Okay, 181 Maryland. Again, this is the neighbor to the first property that we looked at today. It's a 1950s walk-up, built in 1955. This one has 2 stories plus a basement. So we're located directly south of Broadway on the west side of Maryland. This is the West Broadway neighborhood. Again, it's being used as a multifamily residential building. The site size is 6,138 square feet, and it's zoned multifamily. We've got 11 suites, again, 5 bachelors, 6 one-bedroom units. Now, in terms of the assessor's workup, we didn't see it beforehand, but we assumed that they were using 4.8. We imputed that, which appears to be what they used. But again, we're using a cap rate of 6%, which is in line with the 6.5 that we use for the, in terms of equity. If we want to talk about equity, the property that's in objectively poor condition next door is 6.5. We're suggesting this is 6% based on its age. So when we take our stabilized income and expenses as reported by the owner, we do come to everything looks reasonable. We've got $1,300 per suite on the R&M, 49% expense ratio, which is reasonable if not low for a property of this vintage. We come to a indicated market value of $920,818, rounded to $921, and we do respectfully submit that the value for this tax year not exceed $921,000. I've included some marketing photos. Again, I think some of these marketing photos were actually used in one of the other properties that we see as a typical suite. So again, we don't tend to look for marketing photos, but I was able last week to go in to the suites and have a look. Those have been provided to you. The balance of the brief are the income and expense submissions, as well as the, I believe we have the previous applicant's brief in here as well, showing that they used an equity argument based on imputed caps through sales, and they were asking for a much higher cap rate. And their stabilized income is not done in the same way that we do it. So it is new information. They were asking just interestingly for a cap of somewhere between 7.26 and 7.79. Again, census data for West Broadway, we see that the average income and median household income is very low, and so we do have a sense that this is a less than desirable neighborhood for an investor, as we've pointed out. So our 6% cap rate, we believe to be fair and reasonable for this property. Thank you very much.
Thank you. Mr. Barocas,
No
questions?
questions.
Mr. McIntyre?
I have no questions.
Ms. Nesbitt?
No questions, thank you.
Commission, either party?
No.
Okay. We'll go on to Langside, number 42 Langside Street. Mr. Barocas, I understand there might be a recommendation on this property. That's according to my notes. News to you?
And your brief.
And your brief.
42, like I said, right? Sorry, let me, I'm printed out an older version of the brief here. So I would have used, somebody gets that here.
Tell us what the recommendation is.
So I used the most recent mailer, the 2017 mailer, because we were overstating the net operating income of the property. So recommendation to $1,053,000.
Sorry?
$1,053,000 from $1,220,000.
Mr. Story?
Thank you, but I'd like to proceed.
Okay, Mr. Barocas, the floor is yours.
So the model was overstating the income producing potential of the property. So basically what I did is I took the most recent year that they submitted and I used that net operating income, stabilizing the management at 5%. And I used our model cap rate and came up with an amended value of $1,053,000 rounded, I believe, looking at the applicant's net operating income here, we're within $1,000 of each other. So again, it's a cap rate issue. So the property, it's
Not according to what I figured here. What did you say your NOIs?
my
were close?
NOI is very close. It's 53,000. It's 718.
Is that on a different sheet?
Oh, that's based on the
That's
recommendation.
based on my
Okay.
record. So I'm just breaking down the record.
Okay, no, okay.
Because I don't have that.
So
It's on. Okay.
the applicant says 54,356. So again, it's a cap rate issue on this one. So it's in Wolsey between Westminster and Cornish. Made the recommendation based on the 2017 mailer and the model cap rate. So again, this one is a cap rate discussion. Okay, so without going into it, that's my evidence.
Thank you, sir. Mr. Story, question?
Just very quickly. Now, you haven't visited this property specifically, I'm guessing. Have you been down this stretch of Langside? Are you familiar with where this is in the city?
I'm familiar,
Yeah, so this is behind Balmoral Hall and that sort of loading area. There's a number of turn of the 20th century apartments there.
I haven't been down there in a while, but it seems to be
Okay. But this one was built in 1911, correct?
originally, yeah.
Yeah. And then do you have any notes on what precipitated that change to 1952?
There was work that was done. I don't have a permit or a price of it, but I mean, on page 9, looking at the rents they're getting and then looking at your photographs, which I would have reviewed before, but should have put in my brief shows, there is work that's being done. So that's why it hasn't affected.
Well, sure, it's not original to 1911.
That would be crazy.
Right, okay. So just so we understand, somebody from the assessment department at some point went into this property and said, no, it ought to be adjusted by, call it 40 years or something like that. But that's an arbitrary judgment call, is it
It's a
not?
judgment call, yes.
Okay. All right, now, I couldn't help but notice on page 2, you've got sales here, and you've got a sale in 08 for 510, but a sale in 02 for 620. So that would indicate that that's a depreciating value in terms of this asset's market value?
Well, the second number is lower, so it would look like they paid less at a later date.
Right, so that would be a depreciating market value in terms of its sales.
That's definitely not typical, but that's what happened.
So does that raise any red flags to you, or does that give you any cause for alarm? Or do you think a purchaser doing their due diligence might look at that and say, that's atypical, that's a potential issue to look into?
I think that's a long time ago. So that,
08?
I think that wouldn't factor into current market conditions or market conditions as of 10 years prior. Lots changed since 08.
Okay. Typically, we'd be seeing large increases in terms of multifamily assets from the last 10 years in terms of their market value and assessed value, would we not?
Yeah, that's a totally different time.
Okay. Well, it's a 10-year holding period, which is actually pretty typical in terms of multifamily investment. Now, the net operating income you've adjusted, so that's fine. Now, you were off by about 16%, and that was the model that was incorrect, correct?
Yeah, that was the model.
So could the model be incorrect about the cap rate as well?
Could the model be incorrect?
Yeah, if the model, if once you do a site-specific analysis of the NOI and you find that it's overstating the income by 16%, is it reasonable to think that, well, maybe the model is also applying an inappropriate cap
Like the
rate?
effective age should come down and it should be fit into a different category with a higher cap rate is probably most attractive, right?
I'm saying that it should probably have a higher cap rate to be certain, but I'm also saying that if we only defer to the model without doing a site-specific analysis, we could end up with distorted market values. Okay, so again, just for interest's sake, do we have your cap rates here, your cap rate table? We don't have your 4 cap rates, Ward, Maxwell, Roach. We don't have those here. Okay,
It's
so
the
those,
same ones. It's the same ones.
but they're not submitted for this brief, correct?
No, they didn't go into this.
Okay, so all we can talk about then in your evidence are the broker studies. And then again, the broker studies would suggest, now, just clarify for me, are you of the opinion that this is an investment grade property?
Define investment grade.
Investment grade would be a property that generates enough income to be desirable to an institutional investor in order to include it in their larger investment portfolio. That would generally be the definition of investment grade.
I mean, it doesn't like the repair and maintenance is through the roof or anything and they fix it up. Looking at the pictures, it looks fine. I mean,
In terms of say a real estate investment trust or something like that, they probably generally wouldn't be holding $1 million asset, would they?
probably more of a smaller
Right,
type of ownership situation in terms of the size of the entity.
right. So based and the income that it generates. So based on your table here, the cap rate ought to exceed 6% based on what the brokers are saying, based on what you're showing us here. Is that not reasonable to deduce?
Now we do it by model, so
So it's all modeled. Okay,
Variance says.
those are my questions. Thanks.
I have no questions.
No questions. Thank you.
Sorry.
Yeah, sorry. Okay, 42 Langside, just very quickly. This building, take a look at it on page 2, you get a sense of what I'm talking about. This is an older building. This is turn of the 20th century. It is not in particularly desirable condition. I've been inside of it. The area is not desirable. So we are suggesting the cap rate be adjusted to 6.25%. And that's consistent in our study for assets built pre-46 up to 59. So that's a very large, spread to be sure. But the city is also, what's interesting here is pre-46 for the city, the model is generally applying 6.1 to 6.6. But then everything from 46 up until about 1974 is a bracket. So we've got some larger brackets. We don't have that many apartments from the turn of the 20th century, but they ought to be applied the higher end of the cap rate study. We do recognize it's not original to 1911, but if we were to apply an effective age, I don't know about any structural work that's been done here, but I think 6.25 is reasonable based on the fact that's our bracket for pre-46 is 6.25 to 6.6, but 46 to 59 is 6.25. It's certainly not, doesn't fit into the 60 to 79 category. So a market view, in our opinion, based on the location, based on the quality of the asset. The suite mix is also an issue. There are no bachelor suites in here, which are the easiest to rent in this area. We believe that 6.25 is reasonable. So with all these factors taken together, we come to 869, 697, indicating a rounded value of $870,000. And we do respectfully submit that the value not exceed $870,000. I've included their marketing photos. You can see the marketing photos are even not quite as glamorous as some of the previous ones. So this is utility grade to be certain. I can corroborate that. I was inside. I've included my photos from my inspection on August 26th, representing the present physical condition. It actually looks fairly similar to the marketing photos included here. So yeah, effectively, this is a question of cap rate. We are of the opinion that you can't use the same cap rate on ward that you use on Langside. That's inappropriate. So 6.25 is what we've applied, again, coming to an indicated market value of $870,000. Barring any questions, that's my presentation. Thank you.
Thank you. Mr. Barocas,
No questions on this.
Mr. McIntyre.
Just one question, because Mr. Story, you had questioned the assessor about the two sales.
Yeah.
Now, is it unreasonable for the market in 2008, given the economic downturn and the stock market issues?
Well, in
affecting real
2008,
estate?
you probably would have been sheltered in a multifamily residential, right? That's probably a safer asset, I would assume.
But on an individual investor basis, if
Yeah.
they were,
Oh, they were hyperextended or leveraged, perhaps. Yeah, for sure. I don't know about the details of it. I just saw that and I thought. But typically, in times of economic downturn, we do see investors paying a premium for multifamily residential. It tends to be seen as a safe haven. We're seeing that now. Hard to say. I don't know about the individual economic conditions for that investor, but perhaps.
okay, thank you.
That's good. Summation to the party?
Yeah. So basically, it's a lot of cap rate here. As per usual. So when you look at the Altis cap rate study, what they do is they intentionally stabilize the R&M low, which lowers the expenses, which raises the NOI over a known sales price, calculates a higher cap rate. They don't have any of these higher, all the cap rates they've used and their border revision study are higher than what they're telling people at the real estate forum. So you have them, they come here and say it's high, and they tell people at the real estate forum it's much lower. Why would you believe what they have? That's my summation.
Thank you. Mr. Story?
Sure, just to reply to that, if you weren't at the real estate forum and you've presented a chart without context, I believe that what we're talking about is the difference between discounted cash flow for the purposes of lending versus direct capitalization for the purposes of assessment. So those are two completely different things, and we all know that. In summation, the burden of proof is on the assessor. The assessor has not provided any calculation, any workup, or any cap rate study to support their cap rates. They've provided a table, which has been, we've gone over a number of times. The municipal board has said that we are not to use assets that were purchased with the intention to renovate for the purpose of driving a cap rate study, and the city continues to use that. But further to that, they've also not included any sort of documentation to back it up. We've provided you a comprehensive study of what is going on in the multifamily universe, and we believe that our cap rates are supported by the market view of these assets, and the city has not provided anything of substance to really even dissect. So that's my summation. Thank you very much.
Thank you, gentlemen. Thank you very kindly for your presentations and results very soon. That concludes our hearing. Thank you.
Thank you.
Have a good day.